Thanks very much, Candice, and good afternoon, everyone. I think this session's going to be a bit of a change in perspective, because what I want to do is to talk about what's going on in the global economy and how it relates to your world. And I have to say that, I think this time last year it was Farnborough, and the world has certainly changed a lot since then. And I want to talk about what that means for the economy, for economic policy, but also for business. I guess the sort of starting point is that if there's one really, really strong message in 2022, is that this is the year when, for the first time in 40 years, the industrialized world, the rich world, saw inflation running at near double-digit rates. I can tell you this is a huge, huge shock. It has eclipsed COVID as the central worry for policymakers, and what happens to inflation is going to determine what happens to the economies of Europe, the United States, and in much of the rest of the world. We're in a situation which actually I don't think any policymaker or economist envisaged as recently as a year or two ago. And it's a situation the like of which we really haven't seen since the early 1990s, when inflation broke out, not to the levels we're seeing now, and we ended up with a recession. Now, there are lots of explanations, of course, for why inflation is picking up, and I'm sure all of you in your jobs, you are dealing with the practical business consequences of elevated inflation. You know, we're seeing it in commodities, wages, food prices, all sorts of areas of the economy. This all started during the pandemic. And if you think about what the pandemic did to the global economy, it caused a staggering dislocation between supply on the one hand, on demand on the other. So economies weren't built to take a 20% contraction in GDP in the space of about 10 weeks. That's what's happened in the UK, where I'm based. A third of the workforce, again in the UK, similar numbers elsewhere, ended up being paid for by government, sitting idle on the sidelines. And when eventually lockdowns were released, people came back and started spending with the benefit of a huge amount of money they'd been given by governments in welfare payments and furlough schemes. And of course, in the meantime, companies have been locking down, cutting costs. I mean, you all will have been on the sharp end of that. And you saw this huge mismatch between demand and supply. And that caused a lot of inflation. Then you had supply chain problems, particularly this year in China, caused by their COVID lockdowns. And of course, in February, the invasion of Ukraine by Russia, which has transformed the environment for energy prices. I was looking at the numbers yesterday. The numbers are staggering. But at the peak last month, European gas prices were 15 times higher. Wholesale gas prices were 15 times higher than the average that had prevailed in the decade or so before the pandemic. So these are a set of huge, huge shocks. And I think, the important thing about this is that if I'd been here 6 months ago, I'd have said to you, most of this stuff is temporary. And if Jay Powell or Christine Lagarde or Andrew Bailey, the governors of the ECB, the Fed and the Bank of England, they would have said the same thing. They're much less certain now. They're worried that this inflation is getting into the system and it's going to need to be hit in quite a big way. Now, if we step back and just think about the role of inflation economies, and we think of the last sort of 50 odd years, and we look at the US. The left-hand chart shows the energy price, shows the oil price, actually, not the energy price, it's the oil price. And those little grey bars denote all of the recessions that have occurred since the 70s. And those of you who are students of economic history, and I'm sure there are some, will know 73 for Arab-Israeli war, huge step up in the oil price, with economies overheating, big recession. 79-80, the Iranian Revolution, huge step up in the oil price. 1990, the first Gulf War, step up in the oil price, recession, and so on. I mean, the financial crisis was different. I mean, it coincided with a peak in oil prices, but obviously the fundamental problem was a dysfunctional financial system. So what we can say is that generally, when you get oil prices, energy prices at these levels, that tends to be a harbinger of recession. And then if we look at the right-hand chart, this is just US inflation. And this is the chart. I can tell you, the Federal Reserve are meeting today in Washington, and they're deciding what they're going to do to US interest rates. The announcement will come through probably around about 7 o'clock Lisbon time this evening. Watch out for it. But they're probably going to be moving rates up by 75 basis points. I mean, this is real shock and awe stuff, 0.75 of a percentage point. But the point is that generally recessions occur after these spikes in inflation. And, why is that? Well, central banks for the last 25 years, their big problem has been that there's been too little demand in the economy, and they've been concerned about deflation and disinflation rather than inflation. And you can see that there's a period, in the sort of 2016 onwards, where you saw interest rates hitting record lows. In the UK, interest rates in the pandemic got to the lowest levels since 1693 when the data were first collected. We've seen extraordinarily low interest rates. All of a sudden, they're dealing with high inflation, and they're raising rates very, very aggressively. And this has quite a lot further to go. If I'd been here a few months ago and you told me the European Central Bank would raise rates by 0.75 of a point, I would have been utterly disbelieving. But that's the kind of territory that we're in. So, I think the big message is we've got to assume rates are going to go higher, because central banks are telling us they are going to carry on raising rates till they've crushed inflation. And we haven't really been in this environment of higher interest rates for a long time. In the States, UK, I think we're looking at interest rates middle of next year, maybe 4 or 5%. These are vanishingly low by the standards of the last 60 years. By the standards of the last 15 years, they're high. So I think the other element in this story is, of course, that what's happening in the energy market, and this is a huge story. In 2008-9, it was about a failure in the financial system, which became a systemic problem. So the problems of banks, the liquidity problems of banks, became a threat to the whole economy, and central banks and governments intervened in a very big way. They nationalized banks, they bailed banks out, they regulated banks. They had to take charge because the private sector could just not manage the risk. And actually, the actions that policymakers took really saved the day in the financial crisis. Fast forward to today, and in some respects, it's a similar story. The quantum of increase in energy prices is such that the household sector can scarcely deal with it. I can tell you, I'm UK-based, but I look at the world. But in the UK, we were looking at energy prices, and we were thinking, well, the feed-through from these energy prices to households are unaffordable. It's not a question that it's going to squeeze households. It just that there will be very substantial numbers of people who won't be able to pay their bills. And what are you going to do? Well, UK government announced they were going to spend the equivalent of 5% of GDP on subsidising energy bills, domestic energy bills, and governments around Europe have been doing the same thing. So we've seen this really big intervention by governments in energy markets to support consumers, and they're also providing support to energy companies themselves. So the worry is some of these energy companies might fall over if they don't get state support and liquidity. And a very salutary warning there from a unnamed executive at an EU bank saying if this pace keeps up, the utility bailout will be a lot larger than the bank bailouts of 2008. So this is a systemic crisis, and governments are responding in the way they do when they face a systemic crisis. They're spending big, and they're trying to protect the private sector. Now, one of the arguments I hear about recessions, and I think this is, it's an interesting argument, is that because unemployment is very low, and I'm sure, certainly we at Deloitte have been facing a red-hot labour market, and I'm sure it's the same for you, and it remains the case. And the argument is, well, how can you have a recession when unemployment is so low? Well, if we look at US and UK unemployment rates since 1970, and again look at recessions, what does it tell us? Well, it tells us that unemployment is always low ahead of recessions, and the reason for that is that low unemployment is a symptom of economies which are running hot. They've run out of capacity, and that's an environment in which inflation rises, and that's when interest rates rise. So, unemployment's always low before recessions. I guess it's worth reflecting on what we can learn from the history of the last sort of 55 years. We've done some work looking at past recessions, and I think the sort of big lessons are that recessions tend to be synchronized events across the rich world. So if Germany, if Europe, the UK goes into recession, you tend to see at the same time or thereabouts a recession in the United States. Now, I think there's probably an emerging consensus that the euro area is likely to see a recession. Much less conviction, more debate about the US, the chance of a US recession, because it's been less hard hit by high energy prices. It's more insulated from the Russian invasion of Ukraine. But nonetheless, I think the risks in America are high. Oil prices tend to rise ahead of recessions tick. And the recessions that we knew in the 70s, 80s, and 90s, they were all about inflation and energy prices getting out of control. The last two recessions, the pandemic, financial crisis, they were external shocks. They were shocks that emerged outside the system to which governments had to respond. This is a kind of an inflationary shock like those previous recessions. In recessions, you tend to expect stress in the economy to rise, and that's around unemployment, a squeeze on incomes, profits, rising debt costs, squeeze on liquidity, and higher business insolvencies. And there are some sectors which tend to reinforce the effects of a downturn, things like manufacturing, construction, discretionary consumer. They tend to be more squeezed, whereas things like IT, real estate, finance, pharma, healthcare, public sector, of course, tend to be more resilient. So not all sectors perform equally in a recession. And of course, it's not just consumers that are on the front end of this, although it is very striking that in the last 6 months in Europe, there's been a collapse in consumer confidence to levels in most countries we haven't seen since the 70s. Business confidence has been more resilient. Consumers are really feeling the effects of these high prices. But it's also about business because I think margins, which have been very high. This is US corporate profits as a share of GDP. They are sky-high margins. And if the US economy slows, it certainly will slow, if it has a recession, it may have a recession, then we should expect those margins to fall. So I think we are, and certainly analysts who follow this sectors are anticipating a marked fall in margins. Now, how do companies behave in a weaker growth, a recessionary environment? And how do CFOs react? We've been running a survey of chief financial officers of the largest UK companies ever since the eve of the financial crisis. And this survey is designed to help us understand the balance sheet behavior of the biggest companies. And these companies are international, so I think this is telling you something about behavior generally. And the left-hand chart just shows you risk appetite. So it's telling you the willingness of CFOs to go out and spend money, to do M&A, to invest, to hire, to expand. And it's no surprise that in the last 2 recessions, risk appetite goes through the floor. So people don't want to take risks, CFOs don't want to take risk. And the right-hand chart, it's a slightly shorter run of data, but this shows the focus on cost control. And of course, what you see is that cost control and holding on to cash become the dominant priorities in a downturn. The numbers haven't risen that far. I mean, I'm struck so far in our survey, we're running it at the moment, that corporates are relatively positive about the future. I think there's a bit of a disconnect between the economics and business sentiment. I would expect that to change. I think the other problem that corporates are struggling with, the other interesting challenge, is that I think a knee-jerk response in an environment of weaker growth to just batten down hatches is not going to be sufficient. And this kind of slide sort of suggests why. I think we've heard an awful lot about the word resilience in the last 3 years. And you can think of all sorts of ways in which the pandemic and the energy crisis, the war in Ukraine, have tested systems that we thought were robust and found them wanting. I mean, the supreme example, of course, is supply chains. I mean, I happen to think supply chains did incredibly well during the pandemic. They just weren't designed for the kind of swings in activity we saw. But I think, in all sorts of ways, the tensions between China and the United States, and to a lesser extent the rest of the West, energy independence, energy security is now up there with climate as a priority for governments. So in all sorts of ways, resilience really matters. And I think a way of thinking about this, if you're in business, is that in a world where things are stable and predictable, like they were before the financial crisis, you don't have to worry. You don't have to invest so much in resilience because it's just not necessary. You're in a predictable world. Where you're in a world where we're suffering the sort of swings and the unpredictability, the kind of deglobalization that we're seeing, resilience becomes really important. It's absolutely a sort of board level issue. So I think this is a real challenge. And just finally, some thoughts on what all this means for organisations, for business. The first point is that I think that sort of one of the biggest challenges in an environment like this is how to balance the short-term risks, the imperative to get through the next few months, which is going to be a particular challenge for businesses with weak balance sheets or challenged business models. How do you balance those considerations with what you do on the other side of the downturn and building the business? There's a great story in the Harvard Business Review about how before the dot-com crash of the early 2000s, Amazon, which was obviously not the titan it is now, borrowed an awful lot of money for expansion. And that was providential because had they not done so, they probably would not have survived. The timing was perfect. But they made a decision then which not only got them through that recession, but actually enabled them to prosper on the other side. So there's something about short versus long term. Recessions cause big change. Of course they do. They shake things up. And some of that's adverse, some of that's about stress. But a lot of it creates opportunities. And one of the things we found in the financial crisis and in the pandemic, CFOs saying to us, is this environment creates an opportunity, a platform to do things that we thought we might do, but we haven't got around to it. It hasn't been the urgency. So I think there's something about, the opportunities. And I think the other thing is, what is it we're all going to be thinking about in 2 years' time when we've stopped worried about inflation? And I think we could say we know a lot of those things, that climate, energy, cyber, tech, resilience, purpose. So we mustn't lose sight of those. I think also businesses are going to be going through a whole set of kind of more defensive measures, looking at exposure to third-party risk. The financial crisis told us that big companies can be felled by insolvent or illiquid suppliers. So exposure to that sort of risk, mapping and testing the resilience of the business. Financing options, I mean, so we're probably going from a world in the States, for instance, where interest rates are close to zero to interest rates of 5% in the space of 2 years. Big change in debt costs as the implications for how balance sheets are structured. In a high inflation world, how do you price your products? What products do you offer? How do you sell them? How do you offer value to customers? Of course, cash and cost are absolutely supreme in tougher times. Reputation and communication. I mean, I've seen this at Deloitte. When things are tough, the invasion of Ukraine, pandemic, Brexit, it really sharpens the focus on good quality communication, timely communication, and actually managing the reputation of the business. So businesses come out the other side of the downturn with their reputations strengthened, not damaged. And finally, people. I mean, I think this is the sort of central challenge. How do we reconcile this red-hot labor market, where wage growth in the States is running about 7%, and the need to hang on to people, this race for talent, with a slowing economy? How do you keep the right people? And I think there is a growing school of thought. The way to do this is that if there is a big downturn, you try to hang on to as many people using strategies like part-time, short-time working, rather than doing what some companies did, many regretted in the financial crisis, which was to actually let large numbers of people go, because the hiring costs on the other side are huge. So that's it, and I think now Candice is going to come up and ask me some unanswerable questions.
Thank you, Ian.
Thank you.
I'm going to ask you some tough ones, I think. And thank you very much for that. I mean, it sounds like a bleak outlook, but as you've shown us, there's a lot of opportunity that lies ahead. So what we've got here is from James: what is GBS's role to play in an increasingly cost-conscious economy?
I deal in high-level abstractions about growth, right? And I think the experience of any individual sector and any individual company can be very different from the experience of what's happening in the economy. And the thing that I've learned as an economist working in Deloitte for the last 15 years, previously I worked for a bank, a big investment bank, was that businesses have huge amounts of agency. This macro environment doesn't necessarily determine the fate of businesses. What study after study shows is that businesses which plan and think ahead and can move quickly can come out of recessions much better with the same set of factors as businesses which are slower, more tardy, less forward-thinking. So, I really emphasize the agency and the power of management. In terms of GBS, to me, there's an obvious answer, which is around how do you improve service and manage costs. And in a sense, this is a kind of, sort of burning platform where once again, CFOs are going to be looking to teams for ideas. And so, certainly, in my role at Deloitte, I'm thinking, well, how do we, what is it that we can do to make a difference in our little world? And I think that's what all of us have got to do, in dealing with our stakeholders. But I think GBS is in a really good position in this sort of environment, because solutions on costs will be at a premium.
Yeah. Absolutely. Next one here: how can we insulate our businesses from the impact of high inflationary pressure?
I think the obvious response is you say you pass on your costs, you absorb them, so your margins go down, or you offset them with improvements in productivity. What's also interesting is a lot of companies are playing around with their product offerings. They are shifting to higher margin products. They're looking at, how do we hang on? Interesting, Amazon's trying to do this. How do you hang on to cost-conscious customers? You don't want to lose them, but you want to reduce the offer and hold on to them so that when things improve, they'll come back and spend more. And so I think there's an awful lot that can be done with pricing. I mean, frankly, we've lost the kind of collective memory about how to price in an inflationary environment. And, you know, businesses, this is what businesses did in the 70s and 80s and to a lesser extent the early 90s. And I think there's a playbook, and we've got to open that book and go back to it. But there's an awful lot you can do without accepting the squeeze on margins.
Brilliant, thank you, Ian. And it hasn't gone unnoticed that last year you couldn't join us in person because you were in Cannes, and we were in person in Basingstoke. But now that we're in Lisbon, yeah. But Ian, it's always wonderful to have you on the stage with us and your Shared Services Conference, and we look forward to hearing from you next year again. Thank you so much.
Thanks very much, Candice.
Okay.